Did you know that the average net worth of a renter today is only $25,000, whereas the average net worth of a homeowner is over $750,000? Guys, you're not alone. Everybody has trepidation, worries, fears about the market, uncertainty. Am I making a right decision? And I'm here to tell you that it's okay. By watching this video, that tells me that you have some discipline and desire to buy a home. And I'm gonna provide you with a guide today to give you the blueprint to owning that first home. Hey everybody, my name is Brian Hogman. I'm the owner and founder of Mission 35 Mortgages, where we help over 1,000 Canadians a year make the right home ownership decisions when it comes down to getting their first home. Before we get started, this strategy, it's not gonna be for everyone. It's a very simple solution, but it is hard to execute. But that does mean if you're one of those people that's committed to going through the steps, you will have success on the other side. So let's get into budgeting. Do you even have a budget? It's not taught in school. Have you ever tried to follow one? This is your starting point. Financial awareness is your #1 step to reaching your goals. Here's what I want you to do right after this video. Take 30 minutes and go through the last month of your PDF and your bank account and see where all the money went. And I'm gonna give you some categories to put them into. The 6 things that I did on my budget that you need to categorize your money into are these. Let's go through the numbers, percentages. What I'm showing you here is the ideal target. When I started this budget, I was nowhere near the ideal. So don't get discouraged. It's a goal that we're shooting for. The first one is the fund account. That should be 10% of your income. The second one is your necessities, which is 40% of your income. The next one, donations and gifts. This is a fun one. That should be no more than 5 to 10% of your income. The last two, savings that get spent. That should be 20 to 25% of your income. And the last one is investing. That's 20% of your income. Now, your totals, when you go back and look at the past 30 days, are not going to equal anywhere near this, just like mine. These are the goals to get to, and I'm going to explain what each of them is for. And guess what, guys? I know when I did this, my numbers were nowhere near what I wanted them to be. But I will tell you this, there are people watching this video right now who are well on track to these percentages. So that means you're probably further ahead than you think. And for those of you out there that are already in line with these budget numbers, you're way further ahead than you think. So stay tuned and we're going to tell you how to shave another 2 to 3 years off your savings plan. So the fund account is going to encourage in you guilt-free spending. You must be spending money in this account. Sometimes when I've done this budget with people in the past, they're not spending anything on fun, which is the wrong way to do it. And some people spending way too much on fun. The fund account must be spent guilt-free spending, no more than 10%. You are not allowed to deviate from that number. The reason you're not allowed to deviate from that number is because you will be on a financial roller coaster, just like I was. When I tried to pay off debt coming out of university, I would pay off debt with every single paycheck and think I was a really great, smart guy. And you know what would happen after 2 or 3 months of doing that? I'd end up blowing the budget and booking a trip to the Dominican. And you know why? Because I thought I deserved it. It's kind of like being on a diet all week and then binging on Friday. So make sure you spend your fund account. Necessities. This is what you must spend your money on. If you have a job and you need to drive there, you need to put gas in the car. Do you need a $1,000 a month car payment, or can you own your car? These are some of the decisions that disciplined people make in order to get to their goals faster. Just a reminder, these are difficult things that you have to do. But guess what? Buying a house is difficult. What we're doing here is building the muscle. The harder things that you get used to doing, the more harder things you can do. You're putting in the reps. Donations, you may not be doing that right now, and that's okay, but you are giving money away. You could be tipping people. You're buying a coffee for your friends. Every time you go to a birthday party or an anniversary or something with your friends, you are likely spending money on a card or a gift. Have a budget for that and plan for it. Then that way it won't be a surprise that eats away your savings. Savings that get spent. There are certain things that you will need to save up for that aren't going to come from 1, 2, or 3 paychecks. For example, you may need a new car. You have to allocate 20% of your income that comes into savings that are going to get spent. Savings that get spent builds the muscle of delayed gratification, because oftentimes you really want to go to that sporting game or go to buy tickets to a concert that costs a lot of money. Savings that get spent forces you to wait and pay for it. And I'll tell you what happens a lot of times. By the time you get the money in there, you might not even want to go. Buying a home is the vacation. That is the goal. Make sure you put the home as the North Star that you're saving for. One little trick that you can do, change your home screen to your main goal. Get a picture of a beautiful home on there, so that way you're looking at it every single day. Where focus goes, energy flows. The last two categories are investing and debt repayment. Now, this might be a little bit different from what we've heard from mom and dad, but I don't recommend you're paying off all your debt first before you start saving, and I'll tell you why. You must be able to do both at the same time. You must get comfortable having debt, because you are always going to have some sort of debt in your life, and you must build both silos at the same time. So the 20% for investing is for the down payment on your house. And guys, I want to pause right now, because if there's one thing I want you to take from this video, it's this. I never would have bought my first house if I only concentrated on paying down debt. The reason being is because expenses kept coming up. The only thing that helped me get in there was that I started doing both at the same time. I paid down my debt to the exact percentage that I also started investing. So my down payment grew and my debt went down at the same time. It wasn't easy, because you know what happens when you make a big payment on your credit card? It gives you a little bit of dopamine. You get a little hit when you pay off that credit card because you feel like you did something good. But try to get used to that hit by putting some money in your first-time home savings account too. Don't go too far down the debt repayment track, because that dopamine hit you get from paying off the credit card is the same dopamine hit you can get by putting money into your FHSA. I'm not telling you not to pay off your debt. You need to organize your debt based on highest interest rate to lowest interest rate. You make the minimum payments based on the percentage of income you have allowed for debt repayment on the lowest interest rates first, then the balance of it goes to the high interest debt. You make this methodical, not emotional, because when you're forced to make a decision on what credit card to make, you'll make an emotional decision. We want to make this systematic for you, so you're set up to win. And guys, I know this is a difficult conversation to have, but if you have trouble with your budget, my team is happy to help out to help you get to where we want to go. So if this is meant for you, there's a specific link below. Fill out the information and one of my team members will reach out. Here's 2 easy wins that you can end up doing right now. Number 1, set a goal for how much you want to have saved in the next 12 months. Second one, set up an automatic payment. This is the best way to do it as soon as you get paid for that bill payment or for the investing account. So as soon as you get paid at $12.59 on a Thursday, that money comes out of your account so you don't even miss it. Fun fact, the average Canadian spends $14,000 on restaurants every single year. Build some discipline, add it to your budget. Your down payment's coming quicker than you think. Guys, what I'm gonna show you next is that there's never been a perfect time to buy a house, and why today you actually have more advantages than ever before. Let's go back in time. Imagine it's 1929 and you're buying a house. This is your great-great-grandparents for some of you. And then you bought the house and the Great Depression hit, one of the worst decades in history when it came down to economic uncertainty. Let's fast forward. 1947, World War II. People came back, very good spirits, an actual optimistic time. However, there was a massive supply shortage. Imagine going to look at a house, going home to have a coffee with your partner and decide whether or not you want to buy it, and it's sold. Houses were being sold quicker than ever before. In 1980, you encountered brutally high interest rates. If you thought interest rates were high today, imagine them 3 times higher. 1990, some would say this was the worst decade to buy a home. We had peak prices, peak interest rates, and a long hangover for things to recover. 2008, headline, global financial crisis. Doesn't sound like a great time to buy a house, but was it? 2017, major overhaul in the mortgage industry. 40-year mortgages reduced to 25 years. Refinancing for mortgages reduced from 90% to 80%. Overnight, mortgage rules tightened. Did the market crash? 2022, peak COVID prices, record low interest rates. Every single one of those times felt like the worst time to buy a house. But it wasn't about timing the market. It was the time in the market. What is different today? Interest rates are at the bottom of a cycle. In the 80s, 90s, we knew they were high. We didn't know when they were coming down. Now, the Bank of Canada has paused for a moment of time. Whenever the Bank of Canada doesn't move interest rates for consecutive meetings, it means we're likely at the top or bottom of a cycle. Prices have dropped 20% from a peak. When you see prices drop that much, there's likely not going to be more of a trough, especially when you start to see them stabilize. This is different from those other periods in time. A big one right now too, supply is plentiful. That means that if you want to buy a house today as a first-time buyer, you have multiple options. And I want to share with you, opportunities not arriving somewhere and seeing everybody there. Opportunities arriving somewhere and not seeing anybody there. This may very well be one of the best entry points in history for a first-time home buyer. What is the same as all those other times that I just went through is economic uncertainty. That will never go away. And there's one big difference about the economic uncertainty that you see today that you didn't see in the past 100 years. You can feel the economic uncertainty every single time you pick up your phone. You might have heard this information 2 weeks later because the time the Bank of Canada made the change, it went through Parliament, then it ended up going to the newspapers, then someone said it on the radio. And it was old news, but it was considered new news. Today, you don't even know where the news is coming from. It could be coming from anybody, and it's coming at you fast and furious. So that's why it's more important than ever to make sure you disseminate the information of what's real and what your goals are. Every single generation, you can ask your parents, your grandparents, your great-grandparents. They had economic uncertainty and they came out ahead. And I'm certain you will too with a long-term plan. Here's where you want to take note to accelerate your down payment. You can come from cash. If you got all the savings, that's great. It can come from a gift from mom or dad, the equity in their home or savings. The third way, the best way, is accelerating the use of your FHSA and your RRSP. How does that work? You can put in up to $8,000 a year into your first-time home savings account. Use that one first because it is totally tax deductible. It will grow tax-free and you don't have to pay it back like an RRSP. So FHSA, number one, RRSP, number two, only after you've done everything in the first-time home savings account, then utilize your RRSP. If you're saving up for a house right now, you should not be using a tax-free savings account. I say again, you should not be using a TFSA only if you've maxed out the first-time home savings account, second your RRSP, then go to the TFSA because it has the least amount of benefit for saving for your home. At the end of this webinar, I'm going to show you something that we're offering as an incentive to set up your FHSA today. There's 3 C's when it comes down to getting your mortgage approved. Number one is cash. That's the down payment on the house. 5%, 10%. We're going to go through the different options and how to accelerate that down payment. Number 2 is your credit. The banks want to know, how are you repaying your bills? There's something called a beacon score, and I'll show you what's a good one and what's a terrible one and how to improve it. The third one is capacity. That's a fancy way of saying your income. How much you get paid or how much income you can prove is going to dictate how much money you can borrow. We'll also break down the differences between T4 salary employees, or for a lot of you out there who have the side hustle, self-employed business, it's much different, and I'm going to show you how that works with the banks too. Let's talk about cash, your down payment. 2 distinct categories you need to know for the down payment. 20% down, no Canada Mortgage and Housing Insurance. Less than 20% down, you must pay mortgage default insurance. What is that? Well, how I like to explain it to my clients, it's a great big huge fee for what feels like nothing. The reality is that default insurance protects the bank in case you don't pay. Sounds unfair, doesn't it? The reality is, before mortgage default insurance was in place, you had to put down a 20, 25, even 50% down payment on a house. So it's actually a good thing. The more money you put down, the cheaper it is. So when you put down 5%, you can do that, but there's going to be a mortgage default insurance cost added to your mortgage. So it's not a cost that you have to pay out of pocket. It does get tacked on to your mortgage loan. Mortgage default insurance is a one-time cost for as long as you own the mortgage. So you don't have to pay it again every single year or when your mortgage renews. And the best way to avoid it is if you can put down 20%. So if you've done a great job with savings, it's a great opportunity to save that money. However, it's not a barrier to entry. You can purchase your first home with less than 20% down. When I bought my house, I opted for a smaller down payment because the time it would take me to save up the extra 15%, home prices were appreciating quicker than I could save up the money. And I felt like I was on the never, never plan in order to get into my first house. Guys, let's be honest here. It's really hard to out save market appreciation because that means a couple things. Number one, you're timing the market because you have no idea, honestly, whether it's going up or down. And number two, you can save more of your paycheck quicker than the investments are going to go up. The reason why I say get in as a first-time home buyer with less down is so you can start to operate with leverage. What leverage is when something small lifts up something big. That's the down payment on your house, your initial investment, lifting up the value of your house. Here's the thing with a house investment too. You've locked in your cash flow in if you have a duplex and you're really smart and you're getting some rental income, or your cash flow out because you can have a 5-year fixed term, a mortgage rate that won't change your payments for 60 monthly payments. So what does that mean? The home is a very predictable investment once you lock in the terms. You have a very good understanding of what your expenses are going to be for your home for the next 5 years. Where can your down payment actually come from? One, it can come from a gift. Mom, dad can actually gift you equity in their existing property or take money out of savings to help you get your first home. Two, it can come from savings. Like we talked about with your budget, you're putting money away every single week, every single month to build up that down payment to get you into your first house. Three, and we're going to talk about this more under our Canada's First Time Buyer Accelerator Plan, how to fully utilize the FHSA First Time Home Buyer Savings Account and your RRSP First Time Home Buyers Plan. These are two exceptional saving vehicles to get you to your down payment super fast. Credit. What does your score really mean? The banks are looking for a credit score for first-time home buyers of 680 or above. What does that mean? It means you make your payments on time before the due date and your credit cards are not maxed to the limit. Making late payments and having your credit cards maxed will bring your credit score lower. What's a bad credit score? Sub 600. If you pull your credit and you're in the 500s, we got some work to do because the banks are going to charge you a lot of money to borrow it if they lend it to you at all. So you know what a credit score is made up of, but how do you actually build it? Number one, payments on time. A hack I use, set up auto payments for the minimum payment every single month. So in case you get busy, you forget it, the minimum payment is always made. And fun fact, it's always better to make the minimum on time than it is to make a huge payment late. That will hurt your credit report more than it will help it. Keep credit card balances to 30% of the limit. The higher that your balance is considered a high balance to limit ratio, will drive down your credit score. Dispute any errors on your credit report immediately. And if you don't have credit right now, get a secured credit card. That looks like giving a company, a bank, $500 and them giving you a $500 credit card. That is the best way to start to establish credit if you have none at all. I know it can be kind of vulnerable to have someone look at your credit, but it's better to know now than after you've got the down payment saved up and you're ready to look for a house and figure out you could have fixed something 6 months to a year ago. If you don't know what your credit score is, that's the first step. You could download a credit app to find out what your score is today. The next step is to see what's on it. If you don't know where you stand with credit, it's kind of like being sick and not going to the doctor. Once you get your credit score above 680, you're ready to move on to the next step, and that's going to be income. The banks look at your income on two different sides. First, we have salaried and T4 employees. That basically means you're trading your time for money. You get paid on an hourly or salary basis, very clear cut as to how you get paid. It's important to know the difference between your regular income, overtime income, and bonus income because not all are created equal. When you get paid overtime, banks are going to want to see a 2-year average of what your overtime is. And they'll only use the average if it's increasing. If your overtime hours are decreasing, they don't use the average. They're going to use the lower of the two. The same goes for a bonus. If you get a bonus, it better be increasing to use the average for the higher number to get you approved for more. These are things my team can navigate through to set great expectations because the worst thing you can do is get a pre-approval, type in your income at 90,000 and think all that 90,000 can be used to qualify because it might not be able to. So when's a good time to get pre-approved? Every time your income changes. The end of the year, you have your taxes done. If it's more than last year, it's a great time to reassess your numbers. Now, if you start a business, a side gig, and you're driving Uber, Instacart, anything along those lines, the banks are going to look at your income different. There's two different sides to it. There's declared income. When you look at your income taxes, there's a top line that shows exactly how much money you made in that business. Then you have deductions off of it. That's your net income. So the banks have one program where they will use your net income, which is significantly lower than your declared income. However, there are other lenders that will use the declared income, which is a higher income number than the net. There's two different ways that the banks can approve you when you're self-employed. They can go the declared route or undeclared. What does that mean? Declared, very simple to verify. We take a look at your income taxes and we can see how much did you declare to the government, pay tax on, that you made from your business. Easily verifiable. The alternative is undeclared, where what we can do is look at your bank deposits with corresponding invoices and see reasonably how much money you made. Now, that one is a little bit more risky for banks, as you could imagine, so they might charge a premium in your rate for that type of financing. This is another reason why you want to get pre-approved sooner than later, because there might be a better way to structure your income to help with your affordability on your first home. And you won't know this until you sit down and talk to a mortgage professional. Today, guys, I'm going to show you 3 different strategies, in my opinion, are the best ones to get into your first home. First one, a duplex. What does that mean? It means it's 2 units in a home. You can live in one and rent out one. Triplex, 1 unit to live in, 2 units to rent out. And then the third option is renting a room, renting out a basement, or what we would call an in-law suite. I'm going to show you 2 strategies that can subsidize your living costs so you're living for less than where you'd rent an apartment. And I'm going to show you one strategy where you can basically live for free. The first one I'm going to show you is a duplex. I rented out the upstairs, which was the nicer unit, and I lived on the main floor, which was a little bit inferior unit because it was just me. So let me give you some numbers. You could buy a duplex today for $700,000. Your down payment is only $45,000. Now you have to pay Canada Mortgage and Housing Insurance on top of that, but the money out of your pocket is the $45,000 plus about 2% in closing costs. What does that look like on a monthly basis? Looks like about $3,400 a month based on a 4.5% interest rate over 30 years. Renting out a 2-bedroom unit in a duplex will yield you about $2,250 a month. That leaves you with a cost of $1,155 a month to own the house. Sure, you still have utilities, property taxes, and insurance. You are owning for less than rent in this scenario. And in your market area, it may be even better. Let's take a look at the triplex now. Same city, same scenario, but the triplex, a nice one, might be a little bit more. So we're using $800,000 for the purchase price of this one. Your down payment, slightly more, $55,000. Based on a 4.5% interest rate over a 30-year amortization, you're looking at just under $3,900 a month. But here's the kicker. You've got 2 units now that are helping pay your mortgage. Maybe a 1-bedroom and a 2-bedroom. What does that work out to in an A-grade city like Hamilton? A bachelor unit would be about $1,500 a month, and a 2-bedroom would be about $2,250. So now you're up to $3,750 a month. So $3,750 a month. That means you're living for about $125 a month. Guys, imagine 5 years from now you kept this property and it started paying you $1,000 to $2,000 a month. That's how you start building your assets. But that's for another video. Lastly, you might have a great single family home in your area where you rent out a room, maybe 2, to your friends in the basement, but they help pay that mortgage payment. Here's the beautiful thing. It might be a lower price point at $500,000 in an A-grade city like Hamilton. Again, 5% down is only $25,000. What does that mortgage payment look like? So you're looking at just under $2,500 a month. You could rent out a room for $750 a month, maybe 2, that's $1,500. So you could be living for under $1,000 a month and owning the house. Everybody gets stuck here. This is your starter home. This isn't your parents' home, your grandparents' home, the one you're gonna get married and have all the kids in. This is the beginner home. That means it doesn't have to be sexy. It just means the numbers have to make sense. Guys, I wanna let you in on something else here too. This is the hidden superpower of a mortgage because everybody loves the idea of real estate going up in value, but the hidden superpower is that forced savings plan. On the average home, we see people paying off over $60,000 a year in principal. That means the mortgage loan is being reduced by $60,000 over 5 years. That is forced savings. That is your wealth and net worth growing just by living there. And hear me out. The home is an asset. It's not your last asset. It's probably your first asset. And an asset isn't just something that pays you. An asset is something that you can use to make money. And that's the next step of building your wealth. But you can't do that if you don't own a home. So I touched on it earlier, but I'm going to go into the nuts and bolts of it now. And this is Canada's first-time homebuyer accelerator program. Here's how it works. You have your FHSA and your RRSP. The government allows you to put $8,000 a year into your first-time home savings account. Most people are at a minimum of a 20% tax bracket. That means that you can use the $8,000 as a deduction off your income taxes. 20% equates to $1,600. What does that mean at the end of the day? If you put $8,000 into an FHSA every single year you do, the government, provided you're at a 20% tax bracket, will give you a check for $1,600 back. So now you just made your $8,000, $9,600. But that's not all. Next, you want to max out your RRSP, home buyers plan. How you do this is, provided you have the contribution room, put $17,000 next into your RRSP. So in the same year, $8,000 into your first time home savings account, then $17,000 into your RRSP. $25,000 each year is how much you invested. 20% back on the $8,000 is $1,600. 20% back on the $17,000 is $3,400. That is how you can turn $25,000 savings into $30,000 every single year. Stack that up over 5 years and you're sitting on $150,000 in savings before you've even added any interest accumulation. Imagine you started this 5 years ago. Where would you be today? Don't delay this. Start it today and your savings starts to build. Last but not least, my good friend, the TFSA, tax-free savings account. If you are looking to buy a home, do not put any money in a TFSA until you've maxed out your FHSA and maxed out your RRSP contribution rooms. Only then should you put the money into a tax-free savings account. The next step is getting pre-approved. It's way easier to change a plan than it is to make a plan. And this first step is making the plan. Once we've started that, it's easy to make changes to your income, to your credit, to your down payment. But we must have the starting point in order to get you into your first home. Listen, guys, we are passionate at Mission 35 Mortgages to help you get pre-approved. We are part of Mortgage Centers Canada, which is part of Dominion Lending Centers Group in Canada, which helps fund $80 billion in mortgages a year. That is actually more funded mortgages than any other lending institution in Canada. We have access to 50 lenders all across Canada, and 76% of our business is repeat and referrals. So we know what we're doing over here. Listen, guys, we're not here at Mission 35 just to get you pre-approved. We're here to build a home ownership strategy. Our goal is to be your mortgage advisor for life. That doesn't mean just helping you get your first home. It's when you renew your mortgage, when you buy your second, your third, your cottage one day. Even if you want to buy multiple investment properties, we are here to help guide you on your financial journey, because at Mission 35, we know for most Canadians, the home is the biggest investment you'll ever make in your entire life. So you might as well do it right and do it with people who have done it thousands of times every single year. So click on the link below, fill out all the information as thorough as possible, and my team is super excited to start putting a home strategy in place. And listen, guys, as a bonus, once you fill out that pre-approval application, we will give you your first $25 for your FHSA as soon as you open it up.